Saving money is important, right? It's something we've all been taught from a young age. We've all been taught to put money aside for a rainy day. It's a fundamental lesson in financial responsibility. But what if I told you that simply saving money in a bank might not be enough? Here's the problem. Inflation. Inflation is a silent thief that erodes the value of your hard-earned money over time. Inflation means prices go up over time. The cost of goods and services increases, which means the purchasing power of your money decreases. That means the money you save today won't buy as much tomorrow. It's a harsh reality that many people overlook. Imagine you save £100 today. It feels good to see that money accumulate, doesn't it? You could buy 100 loaves of bread with that money. It's a tangible way to see the value of your savings. But in a few years, due to inflation, that £100 might only buy you 80 loaves of bread. The same amount of money buys less, and that's the crux of the issue. Your money has lost value. It's disheartening to see your savings diminish in purchasing power. So what can we do? How can we protect our savings from the relentless march of inflation? We need to find ways to make our money grow faster than inflation shrinks it. This could involve investing in stocks, bonds, or other financial instruments that offer higher returns. Educating ourselves about different investment options and seeking advice from financial experts can help us make informed decisions. By taking proactive steps, we can ensure that our money not only retains its value, but also grows over time, securing our financial future. Inflation is like a sneaky thief. It doesn't break into your home or steal your wallet outright. Instead, it quietly erodes the value of your money bit by bit. It slowly takes away the value of your money over time. Imagine you have a stack of cash today. In a few years, that same stack won't buy you as much as it does now. Think of it like air leaking out of a tire. At first, you might not even notice the difference, but eventually, you'll have a flat tire and you'll be stranded. So, why does inflation happen? What causes this silent thief to strike? There are many reasons, but one important factor is the rising cost of goods and services. When prices go up, the purchasing power of your money goes down. As things get more expensive, your money buys less. This can be especially hard on people with fixed incomes or savings. Central banks try to keep inflation under control. They use various tools and policies to manage the economy and stabilize prices. They aim for a small amount of inflation each year, usually around 2%. This is considered healthy for economic growth, but even a little inflation can have a big impact over time. If your savings aren't growing at the same rate as inflation, you're effectively losing money. So how do we protect ourselves from this silent thief? One way is to invest wisely. That's where investing comes in. By putting your money into assets that grow over time, like stocks or real estate, you can outpace inflation and preserve your purchasing power. It's about making sure your money works for you, so you can enjoy life without constantly worrying about the silent thief in your piggy bank. Investing means putting your money into assets that have the potential to grow in value over time. Think of it as planting a seed. You put it in the ground, water it, and over time, it grows into a plant that bears fruit. Investing is different from saving. When you save, you're simply putting money aside. When you invest, you're putting your money to work. There are many ways to invest. You can invest in businesses, property, or the stock market. Each investment has its own risks and rewards. The key is to find investments that align with your financial goals and risk tolerance. One way to invest is by putting your money into businesses. When you invest in a business, you're essentially buying a small piece of that company. Businesses need money to grow and expand. They might use your investment to hire more people, develop new products, or open new locations. If the business is successful, your investment could increase in value. You might even receive a share of the profits, called dividends. Investing in businesses can be risky, especially if you're investing in startups, but it can also be very rewarding if you choose wisely. Section 5. Stocks. Owning a piece of the pie. Another popular way to invest is through the stock market. When you buy a stock, you're buying a small ownership share in a publicly traded company. The stock market can be volatile, meaning prices can go up and down quickly. But over the long term, the stock market has historically trended upwards. Investing in stocks allows you to participate in the growth of successful companies. As companies grow and become more profitable, their stock value tends to increase. It's important to remember that investing in stocks carries risk. There's no guarantee that any particular stock will go up in value. Section 6. Starting small, dreaming big practical tips for new investors. Investing might seem daunting at first, but it doesn't have to be. The world of finance can appear complex and intimidating, especially for those just starting out. However, with the right approach and mindset, anyone can become a successful investor. You can start small and gradually learn the ropes. Begin by setting aside a small portion of your income for investments. This way, you can get a feel for the market without risking too much of your hard-earned money. One popular option for beginners is investing in mutual funds or exchange-traded funds, known as ETFs. These investment vehicles are designed to be accessible and relatively low risk, making them ideal for those new to investing. These funds pool money from multiple investors to buy a diversified portfolio of stocks or bonds. Diversification helps spread risk, so you're not putting all your eggs in one basket. This can provide a more stable return over time. Another tip is to do your research. Knowledge is power in the world of investing. The more you know about the companies or funds you're investing in, the better decisions you can make. Before investing in any company or fund, take the time to understand their business model, financial health, and growth potential. Look at their past performance, but also consider their future prospects. Don't be afraid to seek professional advice. Financial advisors can provide valuable insights and guidance, especially when you're just starting out. A financial advisor can help you create an investment plan that aligns with your financial goals and risk tolerance. They can also help you stay disciplined and focused on your long-term objectives, even when the market gets volatile. Remember, investing is a marathon, not a sprint. Patience and persistence are key to building wealth over time. Section 7. Risk and Reward. Understanding the balancing act. Investing always involves some level of risk. The higher the potential return, the higher the risk. Before investing, it's crucial to understand your own risk tolerance. Are you comfortable with the possibility of losing some money in the short term in exchange for potentially higher returns in the long run? It's also important to diversify your investments. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you can reduce the impact of any single investment loss. Remember, investing is a marathon, not a sprint. It's about making informed decisions and staying the course even when the market gets bumpy. Section 8. Diversification. Don't put all your eggs in one basket. Diversification is a key principle in investing. It means spreading your money across different types of investments to reduce risk. Imagine you invest all your money in a single company. If that company performs poorly, you could lose a significant portion of your investment. But if you diversify your portfolio by investing in a mix of stocks, bonds, real estate, and other assets, you reduce the impact of any single investment loss. Diversification helps to smooth out the ups and downs of the market and protect your overall portfolio. Section 9. The long game, patience, and consistency in investing. Investing is a long-term game. It's not about getting rich quick. It's about making consistent investments over time and letting the power of compounding work its magic. Compounding is like earning interest on your interest. As your investments grow, the earnings on those investments are reinvested, generating even more earnings over time. Patience is key. There will be ups and downs in the market. But by staying invested for the long haul, you give your investments time to ride out the storms and come out ahead. Section 10. Conclusion. Your journey to financial freedom starts today. Saving money in a bank is important, but it's not enough to outpace inflation. Investing your money is crucial for growing your wealth and achieving your financial goals. Remember, investing doesn't have to be complicated. Start small, do your research, and consider seeking professional advice. By understanding the basics of investing and staying disciplined over time, you can beat inflation, grow your wealth, and secure your financial future. Your journey to financial freedom starts today.